Well, 2023 was a year where everyone has managed to beat the odds. From Bitcoin to gold, from small cap index to the kind of action we've seen in the bond market. There was hardly any wrinkle, so to speak, as long as you stayed invested. The only thing I would say has underperformed in 2023 is actually cash and disbelief. If you're sitting on cash, well, you've not participated. If you're in a disbelief and if you're worried about Newton's law of gravity, which is that everything that goes up comes down, then you underperform. So will the party continue for 2024? Are we in for another good year? How is the line of sight looking ahead of elections, and what are the spots of concern and where are pockets of opportunity? Let's take that conversation forward with none other than Hiren Ved of Alchemy to understand that what could be his template of investing for 2024 could be. So what a fantastic year it's been. I mean, you've been investing for so many years, more than 2.5 decades now. I think 2023 in a sense has been a record year of all sorts.
Yeah, it does. I mean, because 2022 was so tough, right? The small cap index was down 14%. Nifty was up only 4% or 5%. So obviously when you come off a low base, things look pretty good, and I think the first quarter of this calendar year was not that great. So we started Feb-March at a low, and then from April we've seen a significant lift off. So yeah, I mean, can't complain. It's been a great year, Nikunj. And you know, I know there is this popular perception that people have that markets have run up very aggressively. Everything has become very expensive, right? I mean, yeah, when you have this kind of an unabated run, 7-8 months on a trot, there are always some areas where there could be euphoric moves. But if you step back, and I was looking at the numbers, right? The total market cap of the Nifty 500 in March 2020, just before COVID, right, was about 100 trillion.
Total market cap of the Nifty?
Nifty 500.
Okay, Nifty 500, okay.
The top 500 companies of this country, right? Which is a fair representation of, it's like 85%, 90% of the market, right? Was about 100 trillion, 100 lakh crore, right? Today, where we stand, it's at 325 trillion.
Okay.
So we've seen a market cap increase of 3x.
In just 1 year?
In about 3.5
years. 3.5 years, from COVID?
From COVID,
low.
Just,
okay.
You know, 31st March 2020 to December here, right? So we've gone up 3.25x as a broad market. And in that, COVID shutdown, COVID recovery, wars, interest rate, oil prices, you name everything, right? Now, interestingly, if you take the total aggregate profits of the top 500 companies in March 2020, we were at about 3,63,000 crores, roughly around, let's say 4 lakh crores to round it off, right? First half this year, we did 6.5 lakh crores. If I just annualize it, usually the second half is better in India, you're talking about 13 lakh crores. So your aggregate profits of the top 500 companies have gone from 4 lakh crores to 12 lakh crores, 13 lakh crores. That's 3.75x. So where are we talking? So markets are very rational, right? Markets, the total market cap is up 3.25x. Earnings are up 3.75x. So at a broader level, I don't think markets are overvalued because they have followed the earnings growth trajectory. But after many years, if you convert that into a CAGR, we're talking about earnings CAGR of 30% plus and a market cap CAGR of also 30% plus. Where have we seen that? We've not seen that for many, many years. And that's why this perception has come in. But I think the story of India, if you ask me post-COVID, is the massive recovery of earnings. Now you can blame it on anything, whether it is banks, NPLs going away or whatever it is. But the fact of the matter is that earnings have gone from 4 lakh crores to 14 lakh crores. It's not a joke. So I'm not complaining. I mean, I think that there is a certain rationale. We all have narratives and stories to talk about, but broadly, the bada picture is that the market cap growth in the last 3.5 years has purely reflected the earnings power of India Inc. And I think that's the big story.
Okay. The other data which Buffett looks at, market cap to GDP, you go above 1, it's a yellow line. You go above 1.5, it's a red line.
Yeah.
The market cap to GDP ratio in India is at about 1.1 to 1.2. And large cap stocks have not participated.
Yes.
Every time when you've gone to 1.5 or 1.4, the end game has been rather disastrous. Whether it's happened in 2008 or it has happened in 2000. Is that a concern now? That we may look at the CAGR growth and talk about the small cap index in the broader market, but on an aggregate basis, markets represents a sum total of earnings and market cap, and which is where I think we're in line with GDP now and above the GDP. So the financial economy right now has become bigger than the real economy. Let me put it this way.
So I'll tell you, there is a reason, and specifically in the Indian context, I think now market cap to GDP will be higher is because a lot of your GDP earlier was in the unorganized category, right? Which was not represented in the stock market. Post all the reforms that we've seen, GST, IBC, broadly the cash economy in the business has come down dramatically. And a lot of that has become formal. Once it's become formal and a lot of that is listed, then it starts getting represented in your market cap, right? So yes, we are above 100% market cap to GDP, but we are not at 150 or 160%, right? So if you go back to our 2008 peak, probably if my memory serves me right, it was 148 or 150%.
Yeah, 1.4. Yeah, 1.4, 1.5 is where you picked out.
1.5,
yeah,
right?
You picked out.
If you look at the US today, it's at 1.7.
Yeah.
And US has consistently traded above 140, 150, right? So yeah, I mean, you are not very cheap at all by any standards, right? But when do you get cheap? You get cheap when there is a crisis. We were cheap during COVID. But you can't expect every year because you want to invest money, the market should be like dirt cheap, right? So those opportunities come once in 5 or 10 years when the market really, when you'll get market cap to GDP at 60% or 70%. But those are factors that you can't predict. So at 110, I think it shows that, it's a healthy ratio. We are not way overpriced, but neither are we in deep value territory either, right? I think we've followed the earnings.
So can I say Indian markets are like a sea facing flat at Nariman Point? It will always be at a premium because there is scarcity for that kind of a view. And that is India for you.
Yes.
Once in a while, once in 3 years, once in 5 years, because of external circumstances like geopolitical tension or COVID, there could be a fire sale.
Yes.
But in general, the approach has to be that India, in terms of in positioning, is a sea-facing flat and Nariman Point, which will trade at a premium.
Absolutely.
Okay.
I have no doubt about that in relative terms, India is better placed. Our macros have never been that good. And India Inc.'s balance sheets are delevered. Earnings capacity has come back. So why should we trade at a discount? I mean, there's no reason to do that, right?
So are we at fair value or are we trading at a premium?
Depends on your time horizon.
Okay.
If you ask me, next 6 months, maybe the small and mid caps are at a premium to long-term averages. Nifty, not necessarily, right? Because I think the large caps have probably trailed the small and mid caps. But that happens. But if you ask me with a 3 to 5 year perspective, I think we are fair. We are not at a premium. Because I do believe that earnings could continue to compound at healthy double digits. Now, whether it's for the Nifty 15% and for the broader markets, it's higher, only time will tell. But I think there is greater certainty and probability that the earnings should compound at a pretty healthy rate.
So you're not looking at raising cash or changing your portfolio mix for 2024?
No.
Why is that?
Because I believe in the long-term story. And Nikunj, we all forget that in a solid structural bull market like we saw between, let's say, 2003 to 2007, and I was looking at the data, every single calendar year, because we are talking calendar year now, and you're asking me about 2024, right? I mean, well, you know, there is always a possibility you could have a moderate year after a good year. But if you look at the data, 2003 calendar, 4, 5, 6, 7, all 5 years, you had positive double-digit returns. All 5 years, right? Except for 1 year, I think, which was immediately after, I think 2003 was like a 70% kind of a year, and then you had a 8-9% positive year. And after that, it was all 25-35% year after year after year. So I think why, and I'm not saying that this will repeat, but I'm saying that this has happened in the past, right? So could you have a moderate year? Yes. Very difficult to predict. But I think you don't invest year by year. You invest with a slightly longer term horizon. And I think the future is very, very positive. So why should I raise cash? As to your question of have you changed portfolios, I think the change in leadership became quite evident, last year and the year before. And as I've said before, that it looks very similar to the bull market of 2003 to 2007-8, where similar kind of sectors are leading today, right? So domestic cyclicals, auto ancillary, cap goods, manufacturing, cement, real estate. It looks very similar, right? Hotels, metals, right? And to that you can add defense and EMS, because in every cycle there are new players that emerge, or renewables, as whatever you would want to call it, right? But broadly in that whole bucket of manufacturing or industrial cyclicals, whatever you want to call it, is where the leadership is in this bull market. And I think that, we have to embrace and we have to recognize that change. And I think the market leadership is telling you, right? I mean, the best performing stocks have been PSUs.
Do you think the party will continue or the rally will continue?
In
PSUs?
Longer term, yes. Near term, I think we've seen a very parabolic rise in many of these stocks, right? So there could be over enthusiasm, euphoria, which could have set in the short run. But an entire asset class doesn't move like this until and unless there is a good reason for it to happen, because markets are not irrational. We could wish it away. You know, PSUs have been a bad name for a long time.
The ugly ducklings have become the swans now. Let me put it this way.
Well, Mr. Modi, on the floor of the House, told everybody that don't ignore PSUs, right? So it's at our peril that we ignore it. So I think, yes, longer term, the way their balance sheets have improved, I think general policy has been quite supportive to creating value in PSUs. But again, I would not have a broad brush that just because you're a PSU. Today what's happening is that anything that is a PSU is going up, right? I mean, like, that's not going to sustain.
What do you like in PSUs? Where have you invested?
So I'll tell you where we have invested is largely our participation has been in defense.
Okay.
Right? Because that was a very clear area where, unlikely that while the private sector will also benefit from greater participation, but I think the big monopolistic players are always going to remain the big PSUs, right? So HAL, the BELs, the BDLs of the world, you're not going to be able to replace that for strategic reasons. It's not going to happen. So I think that's, to my mind, where we've participated the most. We do have some exposure to the renewable financiers.
PFC, RFC both?
Yeah, in our offshore fund, we have some exposure to REC and NTPC. But I think our quant strategies have wholeheartedly participated in the entire PSU pack, right? Because, you know, quants don't have any emotions, they don't have past biases like we have as active investors. It's very difficult to switch gears. Though on the active side, as I said, we have participated largely in defense, but our quant strategies have done phenomenally well by participating in the PSU pack.
At what would be the tipping point at which you would say that I'm going to grab my gains in PSUs? What is the matrix you would use? Would you use valuations as a matrix? Would you use the environment as a matrix? Till how long do you think this rally will continue?
Look, I think these kind of leadership doesn't get over in a year, 2 years. There may be ebbs and flows, but typically these kind of trends last multiple years, right? So I don't want to call it a top as yet. Now, you know, as I said, there could be temporary valuation overreach that could happen. I think it's very simple. You know, you need to not get carried away by the narratives, and you got to look at fundamentals. So I think even within, whether it's PSU or private, finally, if earnings growth and cash flow doesn't come through, then none of those market caps are going to sustain. And if they do come through, and I think broadly you could argue still that barring a few areas, PSUs relative from a valuation perspective were still cheap, right? PSU banks were cheaper. You know, there are a lot of other PSU stocks which were relatively cheap. But I would be very careful and not, you know, assign the bullish fervor to every and any PSU.
What were your top 3 mid-cap holdings at the beginning of 2023, and have they changed as we move from 2023 to 24?
I think amongst the mid and small caps, well, some of them have now become large caps. So as you know, for a couple of years now, we've been bullish on the ER&D space. So, you know, KPIT, Tata Elxsi, Dynamatic Technologies. We've been holding it for 15 years now, right? It was a micro cap, and now it's a small cap. We hope at some point in time it will become a mid cap and grow. But I think the inflection point has come. We also participated in. It's another theme that we like quite a bit, which is luxury consumption, right? So we have exposure to stocks like Ethos and KDDL, which is the parent company, which we've been holding for a while, been quite bullish on it for a while. These are still small cap stocks. You know, I think that we continue to hold that. We don't, you know, small cap investing is also a long-term game, right? So you really have to stay invested in many of these companies for years together. I mean, Varun Beverages was a mid cap when we invested in it. It's now become a large cap company. So we haven't changed much, if you ask me.
Have you participated in any of the recent IPOs, and have you allocated disproportionate amount of money?
No.
You avoided all the recent IPOs?
I think we've just
even
stayed
Tata
away.
Technologies,
Huh?
even Tata Technologies, because it's a play on Tata and technology, and it is like a bada bhai of KPIT, if I put it so, openly.
No, we did not, because again there was too much euphoria, right? After a long time, you had an IPO come from the Tata stable, and for us we were happy because we had exposure to Tata Elxsi, which, by the way, I feel is a far superior business. Both KPIT and Elxsi are superior businesses to Tata Technologies. Not to take away anything from the potential of Tata Technologies or the quality of the business, but I think, the margins tell you the story, the growth tells you the story, right? But I think over time people will realize that KPIT and Elxsi are far superior companies than Tata Technologies is.
Hiren, one of the very basic approach any investor has now is that you look at P multiple. There are websites which give you both trailing and forward P multiple. Some of the mid-cap stocks you own, they cannot be called as cheap stocks. For example, whether it is KPIT or whether it is Ethos or whether it is Dynamatic Technologies, P multiples are north of 30 times, 40 times, even 50 times, depending on the estimate in the company you're looking at. But you are not in a hurry to sell. So when you look at long-term investing, how much importance do you give to this very basic, thumb rule of P multiples?
See, Nikunj, I think the lessons we've learned is that PE multiple is one way to look at valuations, right? Especially when you're investing in smaller companies, you need to look at the absolute market cap and the absolute profit and the size of the business today versus what you believe it could be, right? Now, it's very different in a large cap company where you can't expect profits to double, triple and go up 5x. But it could happen in a small company where optically for current year or next year or maybe the year after that, it could look at 30, 40, 50 P multiples.
Give us an example so that our viewers can relate to that. You said, okay, P multiples were expensive, but you ignored it and your conviction has rewarded you.
No, again, I don't want to give names, but
just we are discussing a case here.
I'm saying let's take an example. If a company has today, let's say 50 crores of absolute profits.
Okay.
And let's say it's trading at 50 times.
Okay.
Right? But if the business is at an inflection point and if you believe that, let's say in the next 3-4 years, the 50 crore profits could become 200 crores, 3x or 4x. What value is that 30 or 40 multiple, right? But very different vis-a-vis, let's say, a company which has profits which is, let's say, 5,000 crores and can't go to 15,000 crores in 5 years because of the base effect, right? And there, if you're paying very high multiples, one has to be careful. So, size and scale at which you look at multiples also matters. So while the multiple itself tells you something, and yes, one has to be very cognizant, but you can, I'm saying that you can ignore these multiples if you believe that profits can go in multiples of where they are today. And I think that is very important. But I agree with you that, things aren't cheap. Very difficult to find stocks. You typically tend to find value only once you've hit a crisis. Is when you really get things cheap. Right now, very difficult.
So what should be a very basic portfolio approach for 2024? They say that you don't get good price when there is cherry consensus. Our good old common friend late Rakesh Jhunwala, he would use this line that bull markets always climb the wall of worry, they come down on ray of hope. And I see a lot of hope around. When there's a lot of hope, it means cherry consensus and bad pricing. Are we in that stage of the market?
Well, Nikunj, it's good to be skeptical, it's good to be cautious. Yes, there is consensus, belief. But that doesn't mean that we can't have a fantastic bull run, right? People forget what happened in Japan.
So don't be contrarian for the sake of being contrarian.
Yeah, just don't. I mean, I just detest the fact that just because we've had a good year, right, we should become contrarian and raise cash. Yeah, but be cautious. Don't get carried away. You know, have reasonable expectations of returns, and you could always have a tough year. Right? I mean, who expected 2022 to be tough? The world is a dangerous place. We're seeing a lot of geopolitical events happen. But, you know, I don't want to be bearish just because it sounds to be good. Because after a great year,
sounds intellectually right to be bearish.
Intellectually right? I mean, I think we are in a good phase of the market. Let's be confident and prepare for the worst, right? And I think ultimately the best insurance policy, I tell my clients, the best insurance policy that you have against any unforeseen risks is the inherent quality of the companies that you invest in. Because even if there is a temporary fall in value, it'll come back. But if the inherent quality of the businesses is not great, then you could have a permanent loss of capital, which is what you don't want. You don't want permanent loss of capital. Temporary loss of value is possible in the market. You know, you can't wish that away. It's part of the game. Now, if you tell me after a 60% rise in small caps and a 40% rise in mid caps, are we going to repeat something like that? Well, you could argue no, right? But as I said, if you look at the numbers from 2003 to 2007, every single year was a double-digit return. So it could or it could not be, but I think I continue to be extremely bullish for the next couple of years. There is no reason to be bearish. You should be mindful of what you buy, at what price you buy, and I think you'll have to keep a long-term horizon but I think the kind of wealth, Nikunj, that we will make in this cycle is going to be unbelievable.
Is there a number you're chasing?
I don't know. I don't want to, the fun in this is to play the game, right?
But Gordon Gekko said on Wall Street, every man has a number. What is Hiren Ved's number?
About what?
I mean, every man is chasing a number in life.
I have no number. Right?
No numbers.
No numbers.
Let's wrap it up with just two final questions. Where do you see a 20% earnings visibility for next 5 years? It could be between 15 to 20% kind of an earnings visibility for next 5 years. CAGR. You know, markets may go up and down, prices may go up and down. So whether earnings they move first or whether it is prices they move first, that's how markets would move. But in your portfolio companies or in the companies which you own, where do you see a 15 to 20% CAGR visibility for 3 to 5 years? Just 3 names.
I won't give names, but I'll tell you areas that look, I think discretionary consumption at the top end, if you have a good company, I think you can compound at 15-20.
What is good company at the top end of discretionary spend? Because there are a lot of ways to perhaps bet on that theme. You bought into Indian hotels, you bought into Ethios, you bought into a lot of other discretionary.
See, Indian hotels, again, these are names, so, all SEBI
we'll have the disclosure, of course.
That we have investments in these companies and people should do their own research. But, liquor companies, I think real estate, if you ask me, real estate is coming out of a 10-12 year bear market, right? And you look at the numbers, it's astounding. I mean, I think the data just came out yesterday, 31% growth in sales in terms of number of units, right? And you must understand that, as India gets wealthy, right? I mean, a 500,000, 2,000 crore market cap company is becoming 5, 7, 10,000 crore market cap company. Usually in India, the promoter owns somewhere between 30 to 50% of his business. Suddenly, he goes from becoming a 250 crore or a 1,500 crore worth family to a 3,000, 5,000 crore worth family, right? And the first thing when people make money is to buy a better house, a bigger house, right? Now the top 100 companies buy houses in London or elsewhere, but you know, the kind of wealth that India is going to create at a broader scale, you can't not be but bullish on real estate. Right?
Real estate, discretionary spend, within that tourism, hospitality, experience-based businesses. It could really be travel tourism or perhaps
luxury, retailing, you know.
That's one theme. Any other theme?
Anywhere where premiumization can happen, you can, I think, you know, you could see solid compounding for the next couple of years.